Good morning and welcome to MarketCast 28. I hope you like the shirt. It's February, so I thought there should be more than just a nod to Valentine's Day, and I greet you this morning with roses. That could potentially be the last bit of great news that I'm going to give you during this MarketCast, because although, well, actually it's a little bit grey outside, we're broadcasting live this morning from the AF Oliver offices here in Bournemouth. Normally we'd be saying sunny Bournemouth, but it's a bit grey today. But I think we all need to be preparing to be taking a summer dip, because following on from the forecast that I gave you at the end of MarketCast in January, in MarketCast 27, I'm absolutely convinced this year that we are going to see a little bit of a dip come summer, possibly taking the year-on-year numbers into negative territory first time for a long time. And we all need to be prepared for that. But I'm guessing all of you are prepared for what we're going to see post March 31st. And obviously the stamp duty changes. We'll get into the detail and we'll cover those off. Let's first of all give you normally I stick the RICS numbers in right at the end of this deck, with almost like a little bit of a frippery on the side, for which, to all of those qualified surveyors, I apologise unreservedly. And this time I'm elevating a couple of charts in your deck right up to the top of the show. Look at this. And there's a good reason for this. This over here, the RICS, as part of their survey, this is the latest survey, the RICS, as part of their survey, give a forecast of how they see the next 3 months and the next 12 months in terms of prices and in terms of sales volumes. Sales volumes I'll cover further off down in this presentation. But in terms of the prices, now bear in mind that the people completing this survey are surveyors. They are the people that come round and value the properties. It's why I give their predictions on price so much more credence than I would do otherwise. Have a quick look at this chart on the left-hand side. These are the surveyors, the national price expectations from the UK surveyors in their January survey. The azure dotted line here is how they feel prices are going to move over the next 12 months. Just remember, this is not the degree of up or down of the price. This is the balance of the surveyors surveyed that believe that prices are going to rise as against the balance that believe prices are going to fall. As you can see on this azure line, that's the 12 months. The vast majority of surveyors believe that prices are going to be higher in 12 months' time than they are now. But look what's happened here to the 3-month number. That has come down to me almost level, and that matches pretty much precisely what we set out in our forecast for you at the end of the January MarketCast. This is a really important number, and this has affected, that was the starting point that has affected my concerns or created my concerns over where the market's going to go in the shorter term. Of course, there's an awful lot going on in the background. Well, we can thank, I guess, President Trump and his mates for much of that. But there is a huge amount of geopolitical stuff going on, and that affects the economy, and that obviously affects the market for all sorts of reasons. And we'll touch on that as we run through in our more normal fashion. I just wanted to show you that chart really before we got underway proper. Let's have a look at the summary then. And I have deliberately left in a couple of lines here that were actually in the January MarketCast as well. But this is an important one. I'm sure you are aware of this already. There has been a big rush for people. We know that stamp duty is the second most hated tax in the UK. People will do anything to avoid having to pay it. They will crawl on their hands and knees from London to Edinburgh on broken glass to avoid having to pay as much stamp duty as normal. And the concession that we've had on stamp duty, Labour Party, Rachel Reeves decided in the last budget that they were going to, as per the plan, do away with that concession at the end of March. That's still going to happen. But now, of course, all these people rushing to meet that March 31st deadline have hit conveyancing holdups. There are going to be a lot of disappointed potential buyers out there. What are our plans to actually cope with those? Do you remember during the COVID debacle, I reckon, when we had stamp duty concessions to try and boost the market, which was really flagging as a result of the pandemic, It was so bad with conveyancing not being able to get the deals through on time that the government of the day, the Chancellor of the day, extended the stamp duty holiday and we got a second spike. I don't think there's any chance of that happening this time. I think people that don't legally complete by the 31st of March will be facing a much bigger stamp duty bill, and we need to be ready for that. I've put this in bold deliberately. There's nothing like a bold sentence in your summary just to get the juices flowing. Finding a way to take advantage of the demand for completions prior to the end of the deadline is crucial. Can you do it? Is your set of panel lawyers good enough to get stock plots completed before the end of March? And if not, what are you going to do to compensate disappointed buyers afterwards? Inflation jumped. Disappointingly, last week we got the inflation numbers and it jumped from 2.5% to 3%. And of course that then diminishes the chances of the MPC bringing down interest rates, which is something they desperately want to do. The word they hate more than anything else is the dreadful stagflation word, that portmanteau word. And of course, inflation has such a pernicious effect, doesn't it, on the economy, on consumer confidence and interest rates, which drive so much of that. There is one bit of good news in there, and we'll talk about inflation in a moment or two, but if you dig underneath the covers of the headline numbers, the CPI, that OOH number stayed at 8% last month, and that for me was encouraging. I know we've got more heating bills to come, so the inflation story isn't over yet. I still think it's certainly not the end of interest rate cuts before the year are out. More detail in a moment or two. So we know that we're going to get distortion of volumes as we go through February and March and then into April as people rush to meet that stamp duty deadline. But I am absolutely convinced that we are returning to what I've called the faithful five in terms of volumes, that classic 100,000 completions every calendar month, which will leave us at 1.2 million completions for the year. You watch that, that's going to happen, even though we're going to see a little bit of a wave as we run through the end of March and into April. And then I believe that summer prices look set for a dip. And let me explain to you why. Key dates, first of all, these are the things that we need to be aware of. On Wednesday, March 26th, we've got the inflation numbers. That's going to be really important for us, this next set of numbers. As I just alluded to there, it looks like energy prices are going to move up again. So although they're way off their peak that we got just after the invasion, the Russian invasion of Ukraine, they're still way above the level they were before that actually started. This is where we stand on inflation. And you can see after coming down from this peak right up here, coming down almost down to the government target of 2%, we started to crawl back up the other side. And you can see we've got there is a worrying trend there. I don't think there's any way that we move back up to these sort of levels. But certainly if this climbs too much higher, then it makes it very, very difficult for the bank to cut interest rates. But the point I was making just now, this dark blue line here, these are the owner-occupier housing costs, and that evened out at 8%. And don't forget the other thing to remember, while we talk about inflation running at the CPI running at 3%, wage inflation is currently running at 4.5%. So actually, affordability or the level of disposable income available is getting better. And certainly when you look at house price inflation, well, we all know that at the end of the year, according to the Nationwide, it was 4.7%. It's dropped since then. We'll come to that in a moment or two. A lot of people in the front line selling houses would actually dispute those numbers, but generally it means that affordability issues are getting better, not worse, despite those inflation numbers. So this is where we stand on inflation. Really difficult to call. Probably going to take another, I'm no economist, probably going to take another tick upwards when we look at those next numbers in March. But this gives me cause for optimism, a little bit of hope that we've seen the worst of that. There is no doubt that we are going to see interest rates come back down this other side. I don't believe in the next 10 years, unless something absolutely dramatic happens, that we're ever going to go back to the post-COVID 0.5, 0.25% interest rates. That was a generational thing that you probably would never see again. But I do think that we are going to see ourselves come back down here to a better level. It might just take a little bit longer than we thought because of the inflation issue. Well, we'll know the answer on March the 20th. That's when the MPC meet next. I said in January, before the February meeting, I said it was 50-50 as to whether or not we'd see a cut. And then, of course, we did. I think it's the same odds here. I genuinely think it's 50-50. Those last inflation numbers are a little bit painful. This meeting happens before the next set of inflation numbers. I think it's 50-50. There are some things that need to happen before that meeting that will actually determine which way they go. There is still every opportunity for another 25-point basis cut. Now, I've got some really important stuff. I am going to show you how to look into the future. I'm going to show you how to read the future. And I want to start with this. A lot of people ask me why I spend so much time looking at the consumer confidence numbers. There are a number of reasons. Number one, this is such a reliable set of data. Bear in mind, this survey has been running since 1974, over 50 years. It's almost as old as I am. And that makes it incredibly reliable. The way the data is collected, the numbers of the sample, the consistency of the questioning, it means it's very, very useful for spotting trends. For us in the residential property market, it's an absolutely essential tool in our armory. And I am going to demonstrate to you in a moment or two why. And I'm going to show you how you can read the future. We create this chart here, but the numbers, the general numbers from GfK are readily available online. And these are the latest numbers that I've put in here. A quick run through again then what this actually means. A little bit like that RICS chart that I showed you earlier on, there is a zero line. They asked 2,000 people, are things going to get better or worse? Much like the RICS. So this is not the degree by which they're going to get better or worse. It is the balance of people that think things are going to get better or they're going to get worse. If it's in positive, above this yellow line, a majority think things are going to get better. If it's a negative below this line, the majority of people think things are going to get worse. Believe you me, there was a day, I could take you back to the day when this line used to regularly be up here in positive. We've been in a negative frame of mind now for some years, and certainly post-COVID, that's for sure. The red line in here is the overall index, and you can see that languishes in the negative, and it took a really big hit in the January survey, really dropped like an alarming drop in the January survey. Little bit of a comeback in the February numbers. That's the overall survey index. This line at the top here, how are your personal finances going to fare over the next 12 months? Are they going to get better or worse? Look, this is what the UK believe about their personal finances. It's right on that line, isn't it? That beautifully characterises the way the UK property market has been working over the last 12 months or so. Excuse me. And if you look at the green line here, is the next 12 months a good or a bad time to make a major purchase? Deep down here in negative, there'd been a general tendency for it to improve. The trend was it was getting better, but just like the overall index score, took a big drop in January. And finally, the nation's view of the economy, which has a huge effect on their decision making in terms of how secure they feel in their job. And don't forget that the employment market has been running into issues over the last 6 months for sure, cooling down significantly. And that is deep down here in negative. And this is approaching record lows on how people feel that the economy is going to fare. I don't think the US presidential elections have helped that either. That also had a little bit of a resurgence, little bit of a comeback in January. Now let me show you a really interesting piece of data here. This is something that drives the way that I look at how the market's going to move. This is the simplified chart of the property survey that they carry out amongst their members. So you've got 100 and odd estate agency groups that all reply to this survey, and they all report on the number of deals they've done at asking price, above asking price, or worse than asking price. And this line here simplifies it and just shows the number of deals that were done at asking price or better. And it reads across here, look, to a percentage. So you can see back in 2022 in that extraordinary good market, over 60% of deals that were being done at asking price or better. Extraordinary numbers, aren't they? Now let me show you this. I've stretched the consumer confidence numbers out here to take it all the way back to November 2021. Why? Because there is about a 6-month delay in terms of how the consumer confidence is before that has an effect, a tangible effect that you are seeing in sales offices and estate agents' offices all around the country. That's about the sort of time that it takes for those levels of confidence to feed through into the market. So all I've done here is I've just picked out 2 of those indices that I mentioned just now. The overall index line, the red one, and then the green one, good time or bad time to make a major purchase. Let me then overlay on those numbers there, confidence numbers there, bearing in mind this is 0 here. Let me overlay deals done at asking price or better. I can do that quite simply. So that all I've done is I've just taken that line I've just shown you, that blue line, the Property Mark survey line. This, do you remember? This was from September 2022, wasn't it? So August 2022, and you can see there, that's where that line has gone. I'm going to take that line now and I am going to shove it back in time 6 months so that the line for deals done at asking price or better sits on top of the consumer confidence numbers from 6 months previous, and it looks like this. And now tell me whether consumer confidence actually has an effect on the property market, and more importantly, it is your ability to be able to look forward 6 months and confidently predict how the market is going to react, certainly in terms of value, if not volume. For me, that's a period over 3 years there. I'm showing you there, 2.5 years. If you really want proof positive of how confidence affects the market, I think it's tough to find a better proof point than that. Onwards and upwards. Let's have a little look at the matrix. We've talked about factors, haven't we, about that actually affects the property market. Do excuse me one moment. Turn the microphone off, somebody. Thank you. I've talked about factors. It's live. There's nothing you can do about that. If you've got to blow your nose when you're presenting live, you've just got to blow your nose. To be fair, the alternatives aren't pretty. This is the market factor matrix from February 2024. So let's just have a little look. Look at consumer confidence, by the way, sat here right in the middle. Don't forget, these are things that either have a positive effect on the market or a negative effect on the market. Low impact, so insidious stuff going on in the background, or high impact, things that really affect people's buying decisions on the day. Let's just take that through its 12-month transition. And this is where we come to. So consumer confidence moving backwards, moving further into the negative, and moving further along the impact line as well. So a slightly higher impact than it had before. General inflation has got better, still generally negative, but a lower impact now than it was before, as are homeowner running costs. Look where the employment market has moved. This is what I was talking about just now, and this is very important to us. It affects confidence, it affects people's decision-making process, and we can see that has moved down and it's creeping up the impact line. It was back here on low impact, it's creeping up and it's moving down into negative as well. Those lifestyle changes are sitting in a neutral zone, but right at the end of the impact line up here. The stamp duty changes, well, they're on the high impact line at the moment because they're right in the news. So we'll see how that moves and develops as we come through the end of March. Affordability, well, affordability is improving slightly. It still obviously stays in high impact. High mortgage rates still in negative and relatively high impact. And the stuff that the developers could do sat still on their own, sat up in that golden area, the top right-hand quadrant here, part exchange, financial products really important now as we come out the end of the stamp duty changes and how that we might compensate buyers who feel hard done by if they've missed those tax savings. So very much ball in your court. But the one thing to say about all of those blue items there is that they affect margin. So they are margin attritional. Quick look through the indices. Can't believe how quickly 20 minutes has just rushed past. It's all this nose blowing. That's what it is. The Rightmove index has came out this week. As you can see, they're at 0.5% for their monthly increase. Lower than you'd normally expect this time. These are asking prices. Asking price. I've just shown you a chart that there is less than 20% of asking prices getting achieved. So 80% of these asking prices will not be achieved. Just bear that in mind. So they're a year on year, 1.4% up on asking prices. And this is interesting though, increase in the number of sales agreed versus this time last year, 15% up on the Rightmove chart. Couple of bits to pick out of here. Number of available homes for sale is at a 10-year high. I think that's really important. Sales, the sellers come to the market now 13% ahead of where they were this time last year. Well worth going online to the Rightmove thing and having a look through the detail. It's really informative. I stuck a few of their charts up because guess what? After I don't know how long, they've decided to redesign all their charts. There's still a little bit of the old Rightmove green and black in there, but I thought they would look rather pretty, so I stuck them in the deck. Seriously, you can see here, this is where asking prices have gone according to Rightmove, pretty much what we'd expect. In fact, normally I'd expect that to be higher up here. So I think that's a really good indicator of how that low consumer confidence is stopping sellers getting over ambitious. And down here, look at the time to secure a buy on a national basis. And in some parts of London, that's even worse. Go have a look at these charts on Rightmove. I've not got time to spend on it now, but worth having a look at. And this is their new regional trends map, which I think is very good. And they've included in here the average days to find a buyer. That, again, is really good and really indicative. You know, I'm a huge believer that all property markets are micro. They are all local. And looking at a national picture is a recipe for disaster, and can get you a smack in the gob if you walk into a sales office in the northeast and say that the average selling price has gone up by 5% this year. So this is a really good indicator of the national picture there. Well worth taking a look at. The Zoopla numbers with their algorithm, of course, which is very, very different, which includes not just asking prices, but sold prices as well, and mortgage approval prices. 2% annual inflation, but there again, they're saying 13% increase in buy demand year on year. I love this Zoopla chart. If you get a chance to go on, I've not got time to spend a huge amount of time on it this morning, but really worth a look. This shows the variance, the gap between the asking price and the agreed price. Absolutely brilliant. Look what happened here, where we went into that unbelievable boom after COVID up to the spring of 2022, and where buyers were just getting whatever they were asking for properties, and we've come back into the real world now. And isn't it extraordinarily consistent? Between 4 or 5% discount, that's what buyers expect, because we're Brits, aren't we? And we never ask the price that we're expecting to get. Here we go on volumes. Look at this. We're back to 66,000 a month mortgage approvals, and we all know what that means. 66,000 mortgage approvals means 100,000 completions. That gives us the faithful 1.2 million transactions a year. The big question for us, because I know that most of the viewers of the MarketCast are new build developers, is what is the new build share of that going to be? But that really demonstrates where we're going with volume. A quick touch on the RICS here. They're talking about buyer demand being broadly flat in January. That's certainly how it's proved. Volume still expected to rise gently. I agree. We're going to come back to that 1.2 million. I showed you their price forecast right at the top of the MarketCast. This is their volume forecast. And even on the volume forecast, look, so the azure line, dotted line there is their view. Over 12 months, will it increase or will it decrease? The majority believe it will increase annually. Look at the 3-month here. That's really come right back down to meeting that center line. They feel a bit like me. There is a summer dip coming. Be sure it will be there. Okay, what about 2025? Because this is where it gets important as we move up towards the end of the March and to the end of March and the distortion that the stamp duty changes have had. Let's just kick off. These were I very seldom spend any time on the nationwide index in the MarketCast for a really simple reason, particularly as nationwide is the yardstick by which I judge my own forecast for the market every year. The trouble is the nationwide comes out on the last day of the calendar month. MarketCast generally, well, here we are today. We're right towards the end of the month. So the numbers I'm showing you here are effectively a month old. So that really then devalues their use. But you know, 4.7%, unbelievably, if you talk to people out in the field, and I do, no one will say, I didn't see 4%, 4.7%, 5% increase last year. Virtually everyone that you speak to says that they felt that the market was flat. Now, I agree, and of course that's where I forecast it was going to be. But importantly, they said 4.7%. There was a slight retrenchment in January, down to 4.1%, as we thought, as predicted last month. This is where we stand. A slight fall in average price from 269 down to 268. But a really great chart on here, important chart on here. Look, this is the price to earnings ratio. If you're a watcher of MarketCast over the months, and you've seen a few of them, you will know that I've looked at this chart on countless occasions, and I've said that long run average of the multiple of earnings that you need to be able to buy your home will always come and gravitate back down to its long run average, which sits here just under 4 times earnings. It will, sure as night follows day, come back down there. Not easy to be saying that. You imagine when this is looking like that, it's tough to be telling people it will come back down to it. But trust me, it will come back down to it, and that's happening right now. So even though you've got house price inflation, we've got wage inflation, which is slightly outstripping it, and those lines then start to converge again, and I believe they will continue to do that. This is my forecast for the year. We've already got the January numbers in, and as I've just shown you moments ago, they're currently with the nationwide sitting at 4.1%. So what they're actually saying there is that their average price for a home in the UK is 4.1% higher than it was in January 2024. So let's be clear about what they're saying there. So my forecast, because everything needs to be judged well. Some people cheat on this. No names, no pack drills, but I set my forecast against a measurable index. And you can see I'm forecasting that there will be a drop down, even though the average price moves, will probably stay level in February and move slightly ahead in March. You can see where I've got that measure, the inflation measure over the previous year going. And this here is my summer dip, which I am absolutely convinced is going to happen. Now, bear in mind, these are average numbers. You know the old saying, take a guy, head in the freezer, feet in the oven. Is he on average comfortable? Average numbers can be really misleading and very painful, but generally the overall feel is going to be a dip through the summer. It's going to be difficult, and we need to prepare ourselves for that. We need to have a strategy aligned. That's how I see it, but there will be a recovery in the autumn, and I still think that we are going to end the year about 1.5% above where we saw it at the end of 2024. So in summary then, as we move towards the end, my New Year's resolution was to try and make these things finish on 30 minutes. It's startlingly difficult to do that because you want to spend so much time talking about the interesting stuff. But that hot rush for the Q1 completions has come smack face to face with the cold reality of how long it takes to take a property through the conveyancing procedure in the UK. It's a scandal, and how it has not changed it, I do not know. I think over the next 5 years, I genuinely think we'll see that change. Got to find a way to take advantage of people that are setting out to beat that deadline. Inflation means that the interest rate fall at the end of March is only 50-50 at best, but it's still a possibility. Get ready for price pressures in the summer. Have a think about margins as you look towards how your developments are going to do as we come up towards the summer. And volumes are going to come back to the faithful 500,000 a month. Of that, I'm absolutely certain. And I still think that we're going to see slightly lower than the long run average in terms of new home share against second-hand for the year, at just over 10%. So that's a real rush through MarketCast 28. We've almost finished bang on time, which is quite extraordinary. Huge thank you to Hannah, to Josie, and to James, of course, who nearly knocked this presentation into a cocked hat by spilling his coffee all over the control desk right at the start. Not his fault, not his fault, just saying. We'll be back in March. We'll confirm the date to you over the next week or two. It's going to be a really interesting one in March. A lot of the fallout at the end of the stamp duty will have become apparent by then, and I'll be able to give you a really good steer of just how those prices and volumes are going to move for the summer. In the meantime, have a super selling end of Feb, and I'll see you next month.